Um, Two reasons for that. The first one is the rise in yields, which we've been having since 2022, since the beginning of 2022. And the second are inflation expectations, which are starting to level off. If you look at the 5-year break-even rates, for instance, which are priced into the markets, we have 100 basis points less than where we used to be roughly 6 months ago. So for these two reasons, real yields are starting to be very attractive now. And on a relative basis, we think that bonds are more attractive than equities at this stage.
Not all markets are created equal, and we still have a central bank that is fairly bent on increasing interest rates to tackle inflation versus a fade we're seeing in some other parts of the world concerned about the growth story. So how do you look at the globe and pick out which fixed income markets are attractive at this stage?
Yeah, so clearly the Fed has been the most aggressive central bank compared to others, but we've also seen other central banks starting to move fairly substantially in their interest rates. I think the key thing right now is to look at where we are in terms of real yields and then compare different regions. And in the US, for instance, you can structure now a portfolio with a maturity of 2 years and a duration of also 2 years. In the investment grade sector, so high quality credits, for about 5 to 6% yields. If you add a little bit of high yields, you're getting to 7 to 8%. These are traditionally the same returns as you would be expecting into equities. All that in a much safer asset class. So clearly, a very strong preference for the US versus other regions, for instance.
But Lars, are you getting enough bang for your buck? If we're talking about inflation rates that remain at 6 to 10%, depending on where we are around the Western world at the moment as well, you're still locking in a negative real world yield.
Yes, Steve. I think what's important is to look where inflation is heading going forward. And in fact, we had 3 different shocks which produced this very strong increase in inflation in 2022. The first one was the pent-up demand because of Omicron. Suddenly you had a new variant of a virus, which was far more benign, but also far more contagious, and allowed us to reopen all the economies except of China much quicker than expected. So a lot of pent-up demand was inflationary. The second thing was supply chains. So don't forget that China continues to be one of the key producers of the world. China embarked on a total different policy with the zero COVID policy, which is being reversed now. So 2023, we will be seeing a much more stable supply chain than what we had in 2022. And the third one is the war in Ukraine, which produced a commodity shock. So all these shocks, or the 3 shocks, which very much hit inflation in 2022, are bound to recede in 2023.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.